Hi friends, myself Subrata Mukherjee, and today I will discuss about cost of capital and will solve some problems on cost of capital. I request the student to subscribe my channel and also see the playlist section of the channel to view or to see the earlier videos. I request all the student to note the problem first in your notebook and then you proceed how to solve the problem.
Today I will discuss how the cost of equity, cost of debt are calculated, are formulated. So all of you have studied about simple rate of interest is equal to PRT by 100. So we are having here four parameters. One is the interest or SI, it is the interest. One is the principal, then R is the rate and T is equal to time. So R is equal to SI into 100 by P into T. This is the basic formula that you have to remember in order to calculate the cost of equity or cost of debt. Now you may argue that how can it be helpful for formulating cost of debt and cost of equity? Now this R is the nominal rate of interest, nominal rate. This R is the nominal rate. But when we will calculate the cost of debt or cost of equity, it is the effective rate. Now let me explain. You have two types of debt. One is irredeemable debt and the other one is redeemable. So let us first discuss about the irredeemable debt. So KI is the cost of debt before tax, which is calculated as I by SB into 100. This is the same formula that we use to calculate the nominal. R is equal to I by P into T into 100. I have explained earlier. Now, this is the same formula that we use here. So, I remains in the numerator, which is the interest, and T is removed. T is removed. Why? Because T is equal to 1. When we calculate cost of debt, then T is equal to 1. So T is removed from the denominator. And this is in the denominator, here it is the principal and here we are taking it as SB. So here when we calculate the cost of debt or cost of equity, rather we are calculating the effective rate. Effective rate we are calculating here. And earlier when we used to calculate in the simple rate of interest, it is the nominal rate. It was the nominal rate, and now we are calculating the effective rate. Why? This is effective because this denominator, the sale value, this changes. So when the debt is issued at par, SB is equal to P minus F. F is the flotation cost and P is the principal. So the principal that is used in the denominator in the earlier equation is the same principal of the face value minus flotation cost. When the debt is issued at premium, then the sale value is equal to face value plus premium minus flotation cost. And if the debt is issued at a discount, then SB is equal to face value minus discount minus flotation cost. So you can easily remember the formula of KI is equal to I by SB into 100. If you can remember, this R is equal to I by PT into 100. Very simple to remember. And KD is the cost of debt. This is cost of debt after tax is calculated as KI into 1 minus T. So this is the tax rate. In case of irredeemable debt, KI is calculated as I plus RB minus SB by N divided by RV plus SB by 2. RV is the redeemable value, that is the amount that will be paid at the end of the when the tenure of the debt ends. SB is the sale proceeds, I have already discussed, and N is the tenure of the debt. So the debt may be issued for 5 year or 10 year or 15 year. And KI is the cost of debt before tax and KD is the cost of debt after tax. So the same formula which is used earlier, the R is equal to I by P into T into 100. The same thing is again used. T is removed because T is equal to 1, and in the numerator you have the interest and in the denominator you are having the principal. So that is the reason we say this as effective rate. It is not the nominal rate. The nominal rate is the rate at which the debt is issued. For example, it may be 10% or 20%. But what is the effective rate? What is the cost of debt to the company? That is the effective rate that we calculate. And RV minus SB is the difference. So if the whatever difference, that is whatever excess amount is paid to the debt holder at the end of the or at the tenure of the when the tenure of the debt ends, it is divided by N. So the total excess amount is annualized. So for example, if the sale proceeds is 10,000 and the tenure of debt is 5 years, so SB say it is equal to rupees 10,000 and RV is equal to say rupees 15,000 and tenure of debt N is equal to 5 years. So excess amount. So this 5,000 is paid over a period of 5 years. So per year it is paid at rupees 1,000, that is 5,000 by 5. So annual interest is the I, and this is the excess amount which is paid. It is what is the excess amount which is paid per year, that is taken in the numerator. So you can easily remember the KI, the value of KI, if you can remember how to calculate the R, the value of R in case of simple rate of interest. Now this KI can again be calculated as like this, because on the excess amount, that is the which is paid at the end of the tenure of the debt, the income tax benefit is not available. So income tax benefit is available only in case of the interest, the annual interest. So KD is equal to I into 1 minus T plus RV plus minus SB by N divided by RV plus SB by 2. Request all the students, so whichever formula you are using, either this one or this one, you have to mention the formula in your answer script and then you use, because either of this formula is acceptable in all the institute in our country, and so you can follow either of these two formula. But whichever formula you adopt, you must write it in your notebook. ICAI Limited has the following book value capital structure as on March 31st, 2016. Equity share capital rupees 40 lakh, 11.5% preference shares rupees 10 lakh, 10% debenture rupees 30 lakh. The equity share of the company sells at rupees 20. It is expected that the company will pay next year a dividend of rupees 2 per equity share, which is expected to grow at 5% per annum forever. Assume a 35% corporate tax rate. Required: compute weighted average cost of capital of the company based on the existing capital structure. Compute the new weighted average cost of capital if the company raises an additional rupees 20 lakh debt by issuing 12% debentures. This would result in increasing the expected equity dividend to rupees 2.40 and leave the growth rate unchanged, but the price of equity share will fall to rupees 16 per share. Cost of equity is equal to D1 by P0 into 100 plus G. This is the dividend model or dividend growth model. Dividend growth model. So the same formula which we have discussed earlier, that is R is equal to I by P into T into 100. So the same formula is used while calculating the cost of equity. See, in the numerator you are having the dividend. The dividend means the interest to the debenture holder and dividend to the equity holder. It means in the numerator we write the return. In the numerator we write the return to the owners. And in the denominator we are having the principal amount, principal. So in case of equity, in the numerator it is written as dividend, and which is expected at the end of the year, because when you invest money in equity share, the dividend is declared or will be declared at the end of the year. So D1, it is taken as D1, that is dividend at the end of the year, and P0 is the price of share at the beginning, price of share at the beginning when you invest in the share, and G is the growth rate. So the same formula which is used while calculating the simple rate of interest is used while calculating the expected return or expected or cost of equity, which is the expected return to the equity holder. So you can easily remember, if you can remember your how to calculate the nominal rate. This is the nominal rate. So K is equal to D1 by P0 into G 100 plus G. So D1 is given at rupees 2, P0, that is the price of the share at the beginning, is rupees 20, and this is 5%. So here it is 10 plus 5 is equal to 15%. KD is equal to KI into 1 minus T. KD is given at 10% and 1 minus 0.3, that is 35%, is the tax rate. So this will be 6.5%. So components, we have equity, preference capital and debt. And what is the cost of equity? 15%. Cost of equity is 15%. Cost of preference capital is 11.5, it is given, and cost of debt we have calculated at 6.5%. Now what is the weight of equity? So this is 0.5. Why? Because it is 40 lakhs by 80 lakhs. Similarly, the weight of preference capital is 0.125 and this will be 0.375. So this is 1. And what is the weighted average cost of capital? So you just multiply 15 into 0.5. So this will give you 7.5, then 1.4375 and 2.4375. So this is calculated at 11.375%. So KO, or cost of weighted average cost of capital, is calculated at 11.375. Now in the next problem, KE again you have to calculate. So D1 is given at 2.40, but your P0 changes to rupees 16, but the growth rate remains the same. So D1 is 2.40, P0 changes to 16 rupees and G is equal to 5%. It remains the same. So your cost of equity now will be changed at 20%. So KD 1 we have already calculated. So this will be 10 into 1 minus 0.35. So this is 6.5%. And KD, the next date that will be issued, it will be at 12%. So 12 into 1 minus 0.35, this will give you at 7.8%. So component equity, preference, debt 1, debt 2, and cost is calculated 20, 11.5 it is given. Now 6.5 we have calculated and 7.8 again we have calculated. So what is the weight? In first case this will be 0.4 because 40 lakh by 100 lakh, because your capital structure changes. Next will be 1.10, 10 lakh by 100 lakh. then 0.3, 30 lakh by 100 lakh, and then last one will be 0.2, 20 lakh by 100 lakh. And weighted average cost of capital, so 20 into 0.4, this will be 8, then 1.15, 1.95 and 1.56. So your cost of capital will be 12.66%. Considering the most desirable capital structure of a company, the following estimates of the cost of debt and equity capital after tax have been made at various levels of debt equity mix. Debt as a percentage of total capital employed, cost of debt, cost of equity. 0, 10, 20, 30, 40, 50, 60, cost of debt 5, 5, 5, 5.5, 6, 6.5, 7. Cost of equity 12, 12, 12.5, 13, 14, 16 and 20. You are required to determine the optimal debt equity mix for the company by calculating composite cost of capital. Debt, this is the weight of debt, this is the cost of debt. Cost of debt is calculated KD, then percent of equity, this will be the weight of equity, and cost of equity. Cost of equity is the KE. So if your weight of debt is 0, then the weight of E will be 1. If this is 0.10, then this will be 0.90. 0.20, then this will be 0.80. So this is the 0.4. If weight of debt is 0.6, then weight of equity will be 0.4. Then cost of debt is given as 5 at 5%, then 5, 5, 5.5, 6, 6.5, 7, and cost of equity is calculated given as 12, 12, 12.5, 13, 14, 16, 20, and cost of weighted average cost of calculated is calculated at KD WD plus KE WE. So this will be calculated at 12%, then 11.3, then 11, then this will be 10.75, 10.80, 11.25% and 12.2%. So this is the least weighted average cost of capital. So your ideal capital structure will be 30% debt and 70% equity. So this is the ideal capital structure where the weight of debt is 30% and weight of equity is 70%.
Hope all of you have understood the problem. I request all the students to note the problem first in your notebook, and then you try to understand the problem in a better way. Thank you.